Picture this. It is the morning of February 7th, 2026. You open your trading app. The screen is a sea of red. The financial media is screaming about a crash. They tell you the precious metals market is dead. They tell you to sell, but they are lying to you. What you are seeing is not a death. It is a deception. While the paper price bleeds out to scare the retail investors, the institutional money is quietly loading the boat. We are witnessing a phenomenon that Michael Oliver calls the rebirth. The charts look broken to the amateur eye, but the momentum structures are screaming that the next move is vertical. We are not talking about $50 anymore. We are looking at a structural target of $500 per ounce. I need you to listen to me very carefully. I need you to turn off the television right now. Close the other tabs in your browser. Silence your phone. What I am about to show you is not a prediction. It is a mathematical certainty hidden inside the momentum structures. This is boring currency. I am the surgeon, and today we are going to operate on the market manipulation. Tell me in the comments below, where are you watching this financial reset from? Are you in London? Are you in New York? Or are you watching from Singapore? Let me know. Let us cut through the noise and look at the autopsy of the price action. To the untrained eye, the charts look broken. The retail investor sees a red candle and panics. They see the price dropping below key support levels and they sell. This is exactly what the algorithm wants you to do. But if you look deeper, if you look at what Michael Oliver calls the momentum structural analysis, the story is completely different. Price is a liar. Price is a distraction. Momentum is the truth. Imagine a beach ball being held under the water. The deeper you push it, the more pressure builds up. The surface of the water is the price. It looks calm. It might even look lower than before. But underneath, the energy is coiling. This is what we are seeing in the quarterly and annual momentum charts for silver. While the spot price on the commodity exchange has been chopped sideways and forced down by paper contracts, the momentum structures have been silently building a massive base. We are looking at a structure that has been building since the high of 2011. That is 15 years of energy stored in a coiled spring. When this spring releases, it does not move in a straight line. It explodes. This is the phase Michael Oliver identifies as the rebirth. Why $500? The number sounds impossible to the average person who is used to seeing silver trade at $30. But you must understand the difference between price and value. The $500 target is not about silver becoming expensive. It is about the currency collapsing. We have to talk about the mechanism of the paper market. The commodity exchange, or COMEX, is a casino where banks trade paper promises. They do not trade metal. For every single ounce of physical silver in the registered vaults, there are upwards of 350 paper claims floating in the digital ether. This is a leverage ratio of 350 to 1. Think about that for a second. If 350 people have a claim check for the same coat in the cloakroom, what happens when 10 of them decide they want their coat back at the same time? The system breaks. This is the forensic evidence of a market that is fundamentally broken. The banks, specifically the bullion banks like JP Morgan and others, have used this leverage to suppress the price for decades. They sell massive amounts of paper silver that does not exist to trigger stop-loss orders on your account. They want you to sell your real position so they can cover their paper shorts. But the game is changing. The rebirth phase signals that the physical market is finally taking control over the paper market. We are seeing signs of backwardation. This is a technical term you need to know. Normally, the future price of a commodity is higher than the spot price because you have to pay for storage and insurance. That is a healthy market. Backwardation is the opposite. It happens when the spot price is higher than the future price. It means the market is screaming for immediate delivery. It means nobody wants a promise of silver in 3 months. They want the metal in their hand right now. This is a signal of extreme physical shortage. Michael Oliver's data shows that once the momentum breaks through the overhead resistance structures, the computer algorithms that currently sell silver will flip. They are agnostic. They do not care about the metal. They only care about the trend. When the momentum shifts, trillions of dollars from hedge funds and automated trading desks will switch from short to long. They will not be buying to invest. They will be buying to survive. This creates a vacuum, A liquidity air pocket. There will be no sellers. Who is going to sell their silver at $50 when the currency is dissolving? Nobody. Who is going to sell at $100? Nobody. The price has to go vertical to find a seller. This is how you get to $500. It is not a slow climb. It is a violent repricing event. The structural base we are standing on right now is 3 times larger than the base that launched silver in 1980. In 1980, silver went from $4 to $50 in a matter of months. That was a 12-fold increase. If we apply a similar multiple to the current base, $500 is not a fantasy. It is a conservative projection based on the expansion of the M2 money supply. The correction you just saw, the drop that scared everyone, that was the final shakeout. It was the trapdoor opening to clear out the weak leverage before the rocket ignites. The insiders are not selling. They are accumulating. They are taking delivery. Do not be fooled by the spot price on your screen. That is the price of a paper receipt. The real price is what you pay to get the metal in your hand, and that premium is already diverging from the paper price. The decoupling has begun. We are witnessing the death of the paper market and the rebirth of true price discovery. Let us travel back in time to understand why the current moment is terrifyingly different from the past. History does not repeat itself, but it certainly rhymes. The last time silver went parabolic was in 1980. The mainstream narrative tells you it was because 2 brothers, the Hunt brothers, tried to corner the market. They tell you it was a bubble caused by greed. That is a convenient lie. The truth is that in 1980, the world was losing faith in the United States dollar. Inflation was raging out of control. People were dumping paper currency for anything that had intrinsic value. Silver went from $4 to $50 in a violent upward spiral. That was a 1,200% increase. But here is the critical difference between 1980 and 2026. In 1980, the chairman of the Federal Reserve, Paul Volcker, had a weapon. He raised interest rates to 20%. He crushed the economy to save the dollar. He made holding cash attractive again, and he killed the silver rally. Today, that weapon is broken. We are currently sitting on a pile of global debt that exceeds $300 trillion. The United States national debt alone has breached $36 trillion. If the Federal Reserve tried to pull a Paul Volcker move today and raised rates to 20%, the interest payments on the national debt would consume the entire tax revenue of the country. The government would default instantly. They are trapped. They cannot raise rates to fight inflation without blowing up the system. This means the dollar has no defender. There is no ceiling for silver this time. The safety valve that stopped the price at $50 in 1980 has been welded shut. Now, look to the east. While Western investors are distracted by the stock market and artificial intelligence bubbles, the geopolitical tectonic plates are shifting. For decades, the price of silver has been set in London and New York. But the physical metal is moving to Shanghai and Mumbai. We are seeing a phenomenon called the arbitrage of the century. The Shanghai Gold Exchange has been consistently trading silver at a premium compared to the COMEX in New York. This means silver is valued higher in China than it is in the United States. Why does this matter? Because arbitrage acts like a giant vacuum cleaner. It sucks physical metal out of the West and deposits it into the vaults of the East. The bullion banks in London are bleeding inventory. They are shipping bars to Asia to capture that premium. This is not just a trade, it is a strategic accumulation. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been explicitly clear. They are building a new settlement system to bypass the dollar. They know that in a world of digital fiat currency, the only thing that grants sovereignty is physical reserves. Russia has already pegged its currency to commodities. China has been importing thousands of tons of gold and silver, far more than their official reports admit. They are preparing for the moment when the paper derivative market in the West collapses. When the COMEX finally declares force majeure, which means they default because they have no metal to deliver. The price discovery mechanism will shift instantly from west to east. The price will no longer be determined by how many paper contracts JP Morgan can print. It will be determined by how many yuan or rubles it takes to buy an ounce of physical silver in Shanghai. This is the geopolitical checkmate. The West is short silver. The East is long silver. And as history shows us, He who holds the gold, or in this case, the silver, makes the rules. We are watching the end of the Anglo-American dominance over precious metals pricing. Now we arrive at the most critical piece of evidence in this forensic file. This is where the rubber meets the road. Forget about the monetary history for a moment. Let us look at the physics. Silver is the single most conductive element on the periodic table. It is the best reflector of light. It is naturally antibacterial. What does this mean? It means silver is not just a precious metal. It is a strategic metal. It is the new oil. You cannot have a modern economy without it. You cannot have the green energy revolution without it. And you certainly cannot have a war without it. Let us look at the solar industry. The governments of the world have mandated a transition to net zero carbon emissions. This requires billions of solar panels. But here's the catch. The new generation of high-efficiency solar cells, known as tunnel oxide passivated contact cells, requires 50% more silver per unit than the old technology. We are talking about hundreds of millions of ounces being consumed every single year just to catch the sunlight. Once this silver is pasted onto a panel, it is gone. It is consumed. It is not like gold, which sits in a vault forever. Silver is burned up by industry. Then there is the electric vehicle market. An electric car uses up to 3 times more silver than a traditional gasoline engine car. Every switch, every relay, every battery management system relies on silver contacts. As the world moves to electric fleets, the demand curve goes vertical. And do not forget the military-industrial complex. In a time of geopolitical tension, silver is a matter of national security. Every Tomahawk cruise missile contains 15 kilos of silver. Every fighter jet, every satellite, every guidance system depends on it. When the Department of Defense needs silver, they do not care about the price. They will pay $500 an ounce without blinking, because the alternative is losing the war. Now, look at the supply side. This is where the crisis becomes unavoidable. We have reached what geologists call peak silver. The easy silver is gone. The miners are now digging deeper to find lower grade ore. It takes 10 years to permit and build a new mine. Even if the price goes to $100 tomorrow, no new supply can come online until the year 2035 at the earliest. The Silver Institute has reported a structural deficit for the 5th consecutive year. We are consuming more silver than we are digging out of the ground. The difference has been made up by draining above-ground stockpiles, but those stockpiles are now critically low. The vaults in London and New York have been hemorrhaging metal. Go to your local coin shop. Call a bullion dealer. Try to buy silver at the spot price you see on television. They will laugh at you. You will pay a premium of 10, 20, or even 30% above the spot price. Why? Because the paper price is fake. The physical price is the real price. We are seeing a complete disconnect. The paper market says there is plenty of silver. Yeah, the physical market says the cupboards are bare. This divergence cannot last forever. When the industrial users, Apple, Samsung, Tesla, Raytheon, realize they cannot get the physical metal they need to run their factories, they will panic. They will bypass the COMEX and buy directly from the mines. That is the moment the price explodes. That is the moment the short sellers are annihilated. The industrial demand floor is rising, and it is about to smash through the paper ceiling. So, where does this leave us? We have examined the corpse of the paper market. We have seen the forensic evidence of the supply deficit. We have traced the geopolitical pivot from west to east, and we have validated the structural momentum that points directly to $500 per ounce. The file is closed. The verdict is clear. The era of cheap silver is over. The rebirth has begun. But this is not the time to celebrate. This is the time to prepare. Because the road to $500 will not be a straight line. It will be the most volatile, terrifying, and psychologically demanding financial event of your life. Most people watching this video will not make it to the finish line. They will be shaken out. They will be scared out. Or they will sell too early for a worthless profit in a dying currency. I'm going to map out 3 specific scenarios that you must be ready for. You need to write these down. You need to memorize them. Because when the panic starts, you will not have time to think. You will only have time to react. Scenario A. The wall of worry. This is the most likely path for the next 12 months. The price of silver will grind higher, but it will be tortured. It will go up $2, then drop $1.50. It will look weak. The news will tell you it is a bull trap. The banks will use every trick in the book to make you bored, frustrated, and doubtful. They want you to sell your position and move into something exciting, like tech stocks or crypto. Do not fall for it. This is the accumulation phase. They are trying to bore you out of your position before the fireworks start. Scenario B, the liquidity trap. This is the dangerous one. If the stock market crashes, and looking at the valuations, it is highly probable everything will be sold off initially to raise cash. Gold will fall. Silver will fall. The baby will be thrown out with the bathwater. We saw this in 2008. Silver dropped 50% in a matter of months before rocketing 500%. If this happens, do not panic. Do not sell. This is the final gift. It is the last chance to buy generational wealth at a discount. If you are using leverage, you will be wiped out here. This is why I tell you, do not trade on margin. Own the asset outright. If you have debt against your position, the volatility will kill you before the price saves you. Scenario C, the overnight revaluation. This is the scenario nobody is talking about, but it is the one Michael Oliver's data hints at. We could wake up one Monday morning to find that the COMEX has declared force majeure. They will simply state that they cannot deliver the metal. They will settle all paper contracts in cash at the closing price of Friday. But the real price of physical silver on the street will be double, triple, or quadruple that number. The market will go bid only. That means there are millions of buyers and zero sellers. If you are waiting to buy until the trend is confirmed, you will be locked out forever. You cannot buy insurance after the house is already on fire. Now, let us talk about the psychology of $500. When silver hits $100, you will feel like a genius. You will want to sell. You will look at your account balance and see numbers you have never seen before. Your friends who laughed at you will be begging you for advice. I need you to resist the urge to sell for fiat currency. Remember why we are here. We are not trying to make more dollars. We are trying to preserve purchasing power. If silver is $500, it means a loaf of bread might be $20. It means a gallon of gas might be $15. If you sell your silver for a pile of cash, you are trading a hard asset for a melting ice cube. You only exit the silver trade when you can swap it for another hard asset. You trade your silver for a piece of farmland. You trade it for a rental property that produces cash flow. You trade it for a business. You never ever trade it back for the paper money that is burning down. This brings me to the most important rule of the rebirth phase. Silence. When the price starts to move, when the headlines start screaming about the silver squeeze, you must go dark. Do not post your gains on social media. Do not tell your neighbors how many ounces you have in your safe. Do not brag to your coworkers. In a hyperinflationary environment, sin or a currency collapse, desperation rises. Wealth envy rises. You do not want to be the target. You want to be the gray man, the invisible observer. You are the bank now. Act like it. Security is paramount. If you are holding physical metal at home, you need to review your security protocols today, not next week. Today. If you are using a private vault, make sure it is outside the banking system. Do not store your wealth in a safety deposit box at a commercial bank. In a bail-in scenario, that box legally belongs to the bank, not to you. Read the fine print. We are entering the final chapter of the great fiat experiment. The mathematics of interest and debt dictate that the current system cannot survive. It is a mathematical impossibility. The only variable is time. Michael Oliver's structures suggest that time is running out. The window to position yourself is closing. The physical shortages are real. The geopolitical shift is real. The debt is real. The only thing that is fake is the price you see on your screen. Do not let them shake you out. Do not let them scare you out. Hold the line. If you want the full technical breakdown, the specific charts from Michael Oliver, and the exact levels we are watching for the breakout, I have linked the full dossier in the description below. Click that link to arm yourself with the data the banks do not want you to see. I also want you to subscribe to the channel right now. We are going to track this event week by week, ounce by ounce. You cannot afford to miss the next update. This is not a game. This is your livelihood. This is your future. Don't trust the words of the politicians. Trust the weight of the metal in your hand. Stay safe.